Traders Corner is brought to you by IG.
Good evening, welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, let's start off with that long position that you took at the top 40 last week, which I imagine must have been immensely frustrating to you because the top 40 was all over the place, and I was sort of wondering how it panned out as far as that trade was concerned.
Yeah, well, look, I mean, we've made money on it, but I'm frustrated with the way it's worked out in the end. If you have a look on the screen now, this is a 1-hour chart of the top 40 cash CFD that trades at IG markets. So now this is actually a screenshot of my trading platform at IG, and you can pull up these charts if you're a client there. So this is now a 1-hour graph. So every candlestick pattern here represents 1 hour worth of trade on the top 40 cash CFD. And recall that I went long of the R2 per point CFD, and I went long of 2 of those. So what it effectively meant was that I was long R4 per point on the top 40 index, and I did that at a level of 45,240. And the thinking back last week was that we had this 45,000 level that was holding as support. That was also support on a daily graph as well. And we had a double bottom there, and the price started to move higher, so I went long, and I put my stop loss at 44,900, which was basically would have meant that this 45,000 support then needed to give way. And it started to work, and last week when I was here, we were reporting that it was quite nicely in the money. And then what happened a day or two later was that it started to move a bit lower, and it began to break this uptrend, which I've indicated with the dotted line over there. And then when it started to make lower lows and lower highs, and basically break back inside of this double bottom area, when I say break back inside of this 45,600 area that I'm highlighting there now, that's effectively the level that validated the double bottom. And when it comes back underneath that level, then you can almost say, well, then the double bottom is no longer valid anymore. Yeah. So I took that as my cue to then exit, and I sold at 45,580. So left a bit of money on the table there from what we had been up previously. But nevertheless, we made some money. We made 1,360 Rand. Now, what happened subsequently was that it did trade lower, so I thought, okay, well, there we go. That was a good move to exit then. Then basically it was Friday morning, Friday the 13th, as luck would have it. The trade actually did go down. We would have been stopped out on this trade because my stop loss of 44,900 was breached during the morning on Friday the 13th of May. And then you can see that what has happened since then is that the market has caught the wind in its sails. It's been aided by a sharply weaker Rand, thanks to all the news over the weekend around potential arrests of Pravin Gordhan and all these sort of things, which just, of course, sends the Rand tumbling. So now the Rand is about 5% weaker at the moment than what it was on Friday last week. And, of course, strap on a 5% weaker Rand, and what happens to our market? It goes higher because we've got so many currency-sensitive stocks in our top 40. So that's what's happened, and the market's now really, really strong when we're not long. So this
is when you really want to lay down on the floor and start wailing and gnashing your teeth, but you can do that for a few minutes, and then you have to pick yourself up and get on with it.
Yeah. That's it. It doesn't help.
Damn it. If only having a tantrum could.
Yeah.
Okay, guys, so now what does the market's rally higher mean for the option structure that you have, which starts entering a danger zone?
Well, this is it, and this is what's bothering me a little bit at the moment, because here is the payoff profile on our option structure, which we've had this thing on for quite a while now, and it runs out until the 17th of June, which is the futures closeout, so that's a month away from today, effectively. And you know, I put this on in the first quarter of the year, at round about here, January, February sometime, when the markets were looking relatively bearish and it looked as if we were likely to break to the downside. And of course, we've seen the markets moving quite swiftly higher. It hasn't been that much of an issue, though, but now it becomes an issue because the way the structure is set up, effectively, I'd sold a call option, a 47,000 strike call option. So I'm short of that call option, and then I'd bought a 43,000 strike put and done some other selling of some further out the money puts. And the trouble with that is that being net written on a call option means that the market, as the market rises beyond your strike price, you then start to lose money. And in this case, 47,000 is the level for us where it all starts to become a bit unpleasant because we then begin to enter what I call this danger zone over here. where we start to then lose money at a rate of 10 Rand per point on this option structure. Now, I'm not hedged at this point in time. As I just explained, we got thrown out of that last Aussie 40 long trade. Now, the market has been trading up around 47,000 today, and it's there and thereabouts, and it's looking like it's a little bit struggling there. So I don't know, but I'm going to have to monitor this very, very carefully in the days and weeks ahead. And I suspect that trying to manage the hedge of this option structure for the rest of this next month until the futures closeout could become a bit of a frustrating exercise. But anyway, I'm going to need to keep an eye on it as it is, and see. What you will recall, though, is that we did have a nice successful trade on the top 40 some weeks back where we made 13,000 Rand. And I consider that sort of, we did do that with the view that we had this long structure, this option structure in place. And that was part of a hedging strategy. So in essence, that did buy us a little bit of comfort. If the market does break above 47,000, then I suppose we'll be losing into profits rather than actually losing capital, as it were.
Yeah. Garth, okay. Now, I know that you want to take a sort of world tour of the markets to kind of set the scene, not going into any new trades this week, but just tell us, starting off with the Russell 2000, it's not an index that we often talk about. Why has it caught your eye?
Yeah, I want to look at a whole bunch of the major global indices that we watch on the markets. And typically when we do the big picture on this show, we've often looked at the S&P 500, and I think we've done that chart so much and it hasn't changed an awful lot from the weeks prior. So I want to look at a few others and take a tour around the world, as you said. So I'm starting with the Russell 2000. We're going to start in the USA and then gradually move our way east. So first of all, the Russell 2000, this is effectively, it represents the smaller cap area of the US markets. And so you're not looking at big cap stocks here like you would be with the S&P 500. Here you're looking at smaller cap stocks. When I say smaller cap stocks, I mean, it's not to say that they're tiny little penny shares. There's still some fairly chunky companies in here.
They're just not Apple or General
Exactly,
Electric,
not Apple, not Google, not Amazon, etc. So you could almost argue it's a more broad reflection of the breadth of the US market than what we typically look at with the S&P 500. Now, what's interesting on this chart over here is to note that, first of all, it peaked last year in about June at a level nearly 1,300. We're currently trading close to 200 points lower than that level. So you can see that this market, this index is a long way off its highs, which is different to the S&P 500. The S&P 500 is not that far off its highs. And this, I think, shows a bearish market structure more clearly than what you would see on the S&P 500 chart. Notice that since the middle of last year, we've had a pattern of falling lows and falling highs. Now, what we've had since February is this big rally, but it's really formed a rising wedge pattern. And these rising wedges are typically continuation patterns within a downtrend. They'll usually break to the downside and then continue lower. And that's exactly what we've seen here. We've seen this rising wedge begin to break to the downside. And also interesting to note that this rally has faltered at the 50-week moving average over here. And I always like to look at the 50-week moving average as a good indication of whether we're in a bullish market or a bearish market. And the fact that the 50-week moving average here is pointing down suggests to me that the general momentum is that this is actually a bear market that we're in on the Russell 2000 here. Also notice the negative reverse divergence on the stochastic oscillator here, and that is also quite a bearish sign. So when I look at this chart, I get quite nervous, and I think that we could actually have another leg to the downside coming here in the next few months.
What about the NASDAQ? I mean, you talk about the NASDAQ 100.
Yeah. So this is the top 100 shares on the NASDAQ, effectively. Yeah. And so this does include some fairly heavyweight companies as well. And what's interesting to note here is this huge, big rounding top pattern that is evident on the NASDAQ over here. We've made a lower high than what we did back in the end of last year. And once again, we've got this rising wedge pattern on the NASDAQ, which has broken to the downside. And that also, from a strict technical perspective, a rising wedge will usually break down and then go back and retest the lows. So if that is to be the case, then we could see this NASDAQ market coming back down here to around about 3,800 or 3,900. And that's a fairly meaningful pullback. And that's another 10% down from where it's trading currently at the moment. So again, not a particularly great looking chart setup here.
And then, Garth, I know you wanted to start west and move east, so that takes us to middle of Europe. The DAX has been an interesting chart to look at, although you're going to start with the FTSE.
Yeah, I'm going to start with the FTSE and then we'll look at the DAX in a minute. So the FTSE 100, this is the London Stock Exchange, effectively the top 100 shares listed in London. And again, notice how it peaked in about April last year, and it's been trading lower ever since, lower lows, lower highs. And again, what we've got over here on the FTSE 100 chart is a rising wedge pattern, which has also failed at the underside of the 50-week moving average. That's that blue moving average over there. And also, again, notice how we've got the negative reverse divergence happening on the stochastic oscillator here. And that rising wedge has now broken to the downside, which once again indicates the potential for further weakness in the months to come.
And the DAX?
All right, and the DAX is, once again, a fairly familiar pattern that we're seeing over here. The market peaked in April last year. It's been making lower lows and lower highs ever since. It has been forming what looks to me like a bear flag pattern over the last couple of months, since that bounce in the beginning of February, really. This market's been forming a bear flag. If we start to see the DAX breaking to the downside below the bottom end of this flag structure, then that points to further weakness. And the likelihood then is that we're probably going to go back and revisit this area around about 8,750 on the DAX, which would imply a retest of the February lows. And again, look at your stochastic oscillator. It's very overbought and just beginning to turn down from overbought levels now.
I presume the Eastern markets aren't going to offer much of a pretty picture either, although the CAC 40 first.
Let's just look at the CAC. Now, this is the French market list. That's Paris, effectively. And again, similar story. Market peaked in April last year, and it's been making lower highs and lower lows ever since then. Once again, we've got this sort of bearish continuation pattern evident here. It's a rising wedge, which has broken to the downside. And also, again, the market's reversed down off the underneath of the 50-week moving average here recently. So we could quite feasibly see the market going back down to where this dotted line is over here, which is at about 3,900 or so on the CAC. Again, around about another 10% downside from here to get to that support level. And also notice the negative reverse divergence on the stochastic oscillator, which is a bearish setup.
Now, I know there have been some illustrious names sounding rather worried about Chinese debt levels. And I mean, Larry Fink from BlackRock actually was sounding off about that. And I wonder if that's actually starting to emerge in the picture of the Chinese market. Yeah,
it is. Look, the Hang Seng is the Hong Kong market, but there are lots of Chinese shares listed on the Hang Seng. George Soros is another guy who's been banging on about the debt crisis that could be coming in China, by the way. So like you said, some big names. Over here, again, this chart is looking probably a lot more unhealthy than some of the others even that we've looked at. This market, again, peaked in around about April last year, and you can see lower highs and lower lows ever since then. Since February, it's been rallying up in a sort of a rising wedge or bear flag type of pattern again, and it has broken to the downside below the bottom of that structure. And again, from a technical perspective, that points to a move back down to the February lows. And look at your stochastic oscillator. Once again, it's making negative reverse divergence, which is a bearish setup. And it typically points to a move in the direction of that trend.
And then just to end off this global tour of doom, what does the Nikkei look like?
Yeah, it doesn't look very much better, unfortunately. Again, market peaked in the middle of last year, lower highs and lower lows ever since then. And what looks to be forming here is also a possible bear flag pattern on the Nikkei. If we start to see the Nikkei breaking below 16,000, that would then probably point to that market going back down towards 14,000. And again, sort of somewhat overbought, not fully overbought on the stochastic, but quite a concerning setup here as well.
Garth, I have to say, people who've watched the show for the last few years have known you to be a bull, and you're sounding very, very bearish, in fact, almost perma-bearish. Do you think that's a fair accusation?
I don't think, I'm certainly not a perma-bear. We know that perma-bears generally never make money in the long run, but I think there's a time to be bullish and there's a time to be bearish. I've been by and large a bull for the last 6.5 years that we've been running this show. But I think I also like to pride myself in the fact that I look at the charts and I kind of reflect on them, what I see. And when I look at these charts, I don't see bullish charts. These are quite bearish chart patterns to me. So, I don't have a bias. I'm not a bull or a bear by bias. I'm just reporting back on the charts as I see them. And when I look at these charts, it actually looks to me like we could be in some trouble for the months ahead.
Yeah. Then very quickly, last 15 seconds to end off with, not much change to the portfolio then.
No, so we haven't really got any major changes. We're still up 11% for the year to date. The only trade that we've still got open right now is this option structure on the top 40, which is worrying me a little bit, but we'll monitor that day by day.
Although if everything falls in a heap, according to those bearish charts, then you should be smiling.
Then I'll be fine.
June futures close out. Yeah. Garth, we'll have to leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.
Traders Corner is brought to you by IG.